2025 was a year where the mega merger happened, where we transformed. It was very transformative for Multiply 2.0 and Veda as we all merged to create a 134 billion entity that operates, focuses, and invests on two mega sectors, consumer and energy. Today, we are one of Abu Dhabi, if not UAE's, largest investment powerhouses with a portfolio of more than 50 companies operating across 85 countries. This year, we made 7 billion dirham in revenues and 3.6 billion dirham in net income. The 7 billion in revenues are a 311% increase year on year. Where did this increase come from? Four key contributing factors led to this increase. First of all, organic growth of all companies. Second, inorganic growth, such as if we talk about mobility, we've seen ETC invest in more Salat, we've seen media invest in several companies in London, and so on. Three, we have begun consolidation of Tandem, one of our largest companies, one of the largest platform in retail and apparel in Iberia, which we had announced earlier. The deal has closed and we began consolidation in August. With that consolidation, we had 2.7 billion of additional revenue. That's for August until December. Finally, we have 1 month of Ghada and E.0 that contributed to our 311% increase. What's more important here than the number and the increase is if you look at it on a pro forma basis, in order to understand the scale and give you some sort of perspective about what's to come, had all Multiply companies operated the same, had Tandem been acquired in January, and had the merger of 2.0, Ghada and Multiply happened in January 2025, we would have closed with revenues of 25 billion on a pro forma basis. Going to the almost $1 billion, 3.6 billion in net income, also on a pro forma basis, that number would have been 9 billion, more than $2 billion. The 3.6 also had a couple of elements. First of all, positive operational performance across the board, the acquisitions, and a one-off element of 2.7 billion from our divestment of carpooling, selling it to Tableed and CBC.
Let's take a closer look at how the group is currently structured across our pillars, consumer and energy. We tend to think about the group in simple terms, right? We try to build scalable platforms with strong cash generation capability and apply a very consistent value creation playbook across all of them. So over the last 4 years, really, we've grown revenue 17 times, obviously through a series of transformational events. But today our revenue stands at 7 billion. Our EBITDA, as we said, 3 billion, 15 times since our listing date, with a total asset base of 135 billion. So really, we changed our scale and now we are targeting much bigger steps going forward. Our market cap as of the end of the year was 90 billion, with a healthy liquidity for our stock of around 28 million dirham per day.
As of 31st December 2025, the group continues to maintain a robust financial performance with a net debt of 14.4 billion and net debt to equity of 0.15. We closed the year with a cash approximate of 9.2 billion and relatively low average funding cost of approximately 5% at Holdco and AED 48 billion of capital deployed to date. This strength of our balance sheet provides us significant flexibility to continue executing our investment and growth strategy while maintaining prudent leverage. In closing, this was a pivotal year, as we mentioned earlier, transformative, with mega merger happening from December, almost from start of December. We have materially scaled the business. We have diversified our earnings across resilient verticals and delivered strong profitability while maintaining balance sheet discipline. But importantly, our focus going forward is from integration to optimization to extract value, expand our margins, and drive sustainable cash generation for the group. We remain confident in our long-term trajectory and strength of our portfolio, strength of our balance sheet, and our ability to deliver consistent value for shareholders.